For more than 3 decades, Kenya had its own oil refinery. But in 2013, the government scrapped plans for a $1.2 billion upgrade and shut it down. Now the country relies on imported fuels, and the old refinery has been turned into storage. The government says it has no plans to spend money on a new one.
I think it's not something that we want to burden the economy with. But at the end of the day, if you can import refined product cheaper than you can refine it yourself, that's what makes more sense.
Kenya is just one of many countries that aren't investing more in producing fossil fuels. The International Energy Agency says global investments in energy stabilized at around $1.8 trillion last year after falling during the previous 3 years. The biggest jumps in energy investments were in the US and India. But other emerging economies aren't doing so well. Last year, just 15% of investments went into markets where 40% of the world's population lives. Not improving their energy infrastructure could have dire consequences for economic growth and poverty reduction.
The bottom line is that the world isn't investing enough in traditional elements of supply to maintain today's consumption patterns, nor is it investing enough in cleaner energy technologies to change course. Whichever way you look at it, we're storing up risks for the future.
The agency's warning comes at a time when global fuel supplies are under threat from trade wars, protectionism, and rising tensions between some of the world's largest oil producers. Without a quick resolution to these challenges, many economies may soon be fuming over fuel. Mobin Nasir, TRT World.
Well, let's return now to the International Energy Agency's latest report with Spencer Welch in London. He's Oil Markets and Downstream Director at IHS Markit. Welcome to Money Talks, Spencer. If we can begin with the IEA's prediction of a slowdown in global oil demand, how much of that has to do with the rising trade tensions we're seeing between the US and China in particular?
Hi, thank you for having me on the show. Yes, I think that's a significant contributor to the more bearish outlook on oil demand. However, it's not the only impact on that. The relatively strong oil price at the moment. So oil right now is at $70 per barrel. At the start of the year, it was at $50 per barrel, and so that rise, 40% rise in price this year, is also dampening down demand forecasts a little bit.
Yes, and as we know, the steady rise of the oil price since January has been attributed in large part to OPEC and its producers reducing global oil output. Do you think then those countries will be under pressure to perhaps slow down that program in order for the price to come down a little so demand can increase?
Yes, maybe, but I guess there's a number of factors that have happened so far this year. It's not just the deliberate cutting of production, principally by Russia and by Saudi Arabia, but also what we've had is the problems in Venezuela, the economic problems. So the Venezuelan production is on quite a significant decline. The US has also put sanctions against Venezuela, and that's hampered their crude oil exports. And then you've got the US sanctions against Iran, and literally in the last couple of days, they've started to come into force, and waivers that had been allocated to allow 8 particular countries to buy Iranian oil, they've been removed, and so that's all tightening the market. So to go back to your point, OPEC meets in June, and there is a possibility that they may loosen the constraints and allow a little bit more oil back onto the market. But I don't think they're going to fully remove the constraints they've got in place.
Interesting. The US President Donald Trump, as we know, has been putting quite a bit of pressure on Saudi Arabia and the UAE, as well as other producers, to keep the oil flowing and make up for the reduction in supplies caused by events, as you say, in Venezuela and Iran. Do you think OPEC and its allies will listen to Donald Trump on that front?
I don't know whether they'll listen, but you're absolutely right. There's been a regular flow of tweets coming from the US president, encouraging OPEC and their partners to increase the flow. It's interesting really, because the tightening of the oil market is equally because of US policy on Venezuela and on Iran as it is on what OPEC is choosing to do. So US policy is tightening the market, and then the US is trying to almost ask OPEC to help keep the US gasoline prices down to win votes. So oil has always been very political, and it will probably always continue to be very political.
So where do you see oil prices going for the remainder of the year? Will they stay at around that $70 mark, or do you see them rising further or falling back a little?
So we see them rising a little bit further. Typically, oil demand peaks in the summer. The majority of the world's population lives in the northern hemisphere. That's when the weather's better, people drive more, so oil demand peaks. So our expectation is that the market will tighten a little bit. Prices will get to 75 or maybe even at times hit $80 per barrel. And then as we get into the latter part of this year, we expect that prices will ease a little bit back into the lower 70s, maybe even into the 60s. And that's as demand eases. And also, we are expecting another surge in oil production, in crude oil production from the United States, and that will loosen the tightness of the market in the second half of this year and in 2020.
Okay, let's see if your predictions ring true. Spencer Welch in London, thanks so much again for your time.